We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Chase Taylor, global macro strategist and editor at Pinecone Macro Research. Thanks for joining me today, Chase.
Yeah, it's a real pleasure. I appreciate you having me.
Great to have you. So why don't you start by giving us a little bit about your background and how you came up with the name Pinecone Macro?
Yeah, sure. So my background, no business school, no Wall Street experience. Actually came from the military, the Air Force, and did a lot of different things in the Air Force. Worked on B-1 bombers, doing avionics stuff. Then I was most of my career in intelligence, doing geospatial intelligence work. And then I did some acquisition work, working at a rocket research laboratory and some other places. So kind of a lot of breadth in my military career. But about 2008, I got really interested in finance and economics, really economics before finance, and I just kind of caught the bug and went from being really passionate about economics, turned it into really passionate about the markets and just kind of learning how everything worked. And have been blogging for a while, and then kind of launched a business in 2018. So been writing, every week since 2018, since launching the business. As far as the name goes, Pinecone, that comes from what originally got me onto that was a Mark Spitznagel book. And he wrote a lot about conifer trees and kind of their what you would call a strategy, even though obviously trees aren't going to have a meeting and develop a strategy, but in the long arc of evolution, they kind of do have their own strategy, and their longevity and that strategy is what really inspired me to use the name, because I kind of see my own outlook and style kind of similar. And what that kind of goes back to is I mean, first of all, they're the oldest flowering plant on the earth. They go back about 300 million years, but about 50 million years ago, they had lost about 90% market share to angiosperms, which is basically, they compete for territory against deciduous trees, regular trees. And they, since then have taken a giant chunk of the earth back. And a lot of it is through taking a very long-term approach, a longer-term strategy. Angiosperms grow super fast. They can outcompete pine trees, for territory if they go head to head. So what pine trees a lot of times do is they go to, and anyone that's kind of driven up near some national parks up in the mountains, or where it's really rocky or acidic, just kind of bad terrain, you'll see a lot of pine trees. They essentially retreated to the areas that other trees don't want to go. It's very difficult to grow, and they kind of made that their home. And the other thing they do that I've always found really interesting is they use disaster as an ally, especially forest fires. So the really bad conditions you have of forest fires, I know a lot of people, if you think about the pine trees you've seen that have no branches, for the first 20, 30, 40 feet, part of that's to avoid fire. But another interesting thing is they actually won't, a lot of different kind of pine trees won't actually open their pine cones until they're in a forest fire. It'll have to be 2,000 degrees for them to open the pine cone and spread the seeds. And at that point you get multiple benefits. It's usually really windy whenever you're in the middle of a fire, and your competitors are getting killed by the fire. So while your competitors are burning up, you're spreading your seeds and you're growing and you're taking territory. And I just see a lot of analogies in that for investing. And I kind of try to position out in the rocky acidic soil and wait for something to happen. I like to find that undervalued terrain and kind of wait for a fire and use the fire as an ally, not as something to fight against.
Absolutely. That's a great way to look at things. And just kind of going back to your time in the Air Force, you make some really interesting parallels to kind of gain some perspective. In one of your recent letters you wrote, looking at things from the perspective of an SR-71 Blackbird. So that is interesting, and we'll get there in a little bit. But you talk a lot about cycles, you think about them very deeply in your work. So why is it that we have a hard time taking a 500-year cycle seriously? And is this a great example of this recency bias that we have all experienced?
Yeah, absolutely. I think everyone's always looking for the easy button when it comes to trading and investing. They're looking for tips and tricks and small little heuristics they can use. At the end of the day, the most powerful thing you can do to really get an edge is just to figure out where other human beings are extrapolating and where those extrapolations might go wrong and just benefit from it. And that is essentially happening every day, all the time. I've kind of become well known in the last year for a lot of energy trades, nat gas, coal, things like that. And really, it was just a matter of finding a bunch of extrapolations and then doing a bunch of hard work and researching whether those extrapolations were likely to prove correct, and kind of realizing simply absolutely not, they're not going to last, and just positioning for it, waiting for that that forest fire again. And this happens especially with long cycles. So you look at long-term debt cycles, it's not the kind of thing people are positioned for, including Wall Street. Wall Street will definitely look at business cycles, so those short cycles within the big cycle, but really no one's looking at long cycles, whether they be weather cycles or business cycles or debt cycles. You name the cycle, the longer it is, the less people are going to pay attention to it, and the more it will catch them by surprise.
Mm-hmm. And you mentioned this, and this is a great point to kind of touch on here. Why do you analyze the convergence of a capital cycle overlapping with a long-term debt cycle? Can you explain that a little bit more, please?
Yeah, this is something I find really interesting. So I think we're, late innings of the long-term debt cycle. Those tend to run, 75-ish years, where you have a lot of little cycles that end up in the big cycle. And so we're kind of at that turning point on that, where we have too much debt and you have to essentially inflate it away. And at the same time, on top of that, we have a capital cycle where a lot of commodities got way too cheap. And again, everyone extrapolated to like, oh, we don't really even need oil. Oil's going to be under $50 forever. We have already hit peak demand. You got all these kind of crazy extrapolations at the bottom of the capital cycle where, and for anyone that doesn't really know capital cycle, well, it's as simple as, if an industry is doing great and their profits are huge, they're going to be spending a ton of money to go get more of that resource. So if it's oil, you go back to, the early 2010s, oil prices were doing well. So you had everyone in the shale space just borrowing as much money as they could and shoving it in the ground, losing money. It didn't matter. It's just, let's see how much oil we can get because oil is worth a lot of money. Well, eventually that cycle turns because too many people do it and they break the price. So in 2014, there was too much oil, there was too much investment in oil, and it broke. Well, since 2014, no one's invested in oil. So you get, the equal and opposite reaction over time where there's not enough investment, there's not enough oil being produced. So now you kind of have that flip on its head. And that, amazingly enough, tends to happen across multiple different commodities all at the same time, which is kind of what we've seen. You look at something like copper. There's not enough copper for, going 10 years out, like not even close to being enough copper. You need a ton of investment in things like oil and copper and natural gas, coal, and you're just not getting it. So, and that's all happening at the same time, all about the same time as you see that big business cycle kind of turn where you think you're going to start getting, significant and sustained stimulus from governments where they're going to try to keep real rates really low. They're going to try to essentially keep inflation higher. And even on top of that, there's other cycles that you can even overlay on top of those two. So you just get like a really powerful moment where essentially a lot of secular regimes can start to really shift. And obviously the big one there is inflation, because that if you have a regime shift there secularly, that just changes everything when it comes to investing.
So when we look at rates of change as a way to analyze and quantify anything, why can this be misleading? And to get a more accurate picture of where we are, do we have to also look at the absolute levels and not just at the rates of change?
Yeah, so this is something that I've paid a lot of attention to, especially this year. Rate of change is important, and you can really gain some significant, edges, especially kind of short, medium term, on where assets are going to go. If you have a firm understanding of where growth and inflation are going to go, However, with what just happened with COVID, where you had, the worst and shortest recession ever, and then, maybe the best and shortest extreme recovery ever, that blows up all the year over year data for a while. And really that'll kind of reverberate into the future as well. And when that happens, it's kind of important to just take a step back and look at the actual levels that economic data is at, or at least, look at maybe versus pre-pandemic levels, things like that, instead of just year over year, because there's a lot of noise there. And I've seen this, really trip a lot of people up, where they're seeing like, ooh, the growth rate of, indicator X is slowing at, this huge pace, and over the last 3-6 months. And then I would just, kind of pull up my screen and go look at whatever that was, say retail sales. I saw a lot of bearishness about retail sales. And then I pulled up the chart, and retail sales on the level, like actually where it is, was growing at a pace that we would have done anything for. It's just an incredible, strong retail sales, in the teens of percent, where that had really never happened in history. And then all of a sudden you have it happening month after month after month. But because it's slowing from the extreme highs, people see that and go, ooh, that's bearish, like growth slowing. Like, well, no, like the level's still, so high that you have to really take that seriously. And that happened across, the prices of assets, but it really happened a lot in economic data. And that really tripped a lot of people up. The economy's significant, like it's really strong right now. Demand is just different than it has been, especially post GFC.
Demand is really strong, but yet supply in a lot of areas is really constrained, right?
Yeah, absolutely. It's a interesting mismatch, and I think a lot of people are looking at this as, supply constraints, a supply problem. But in reality, if demand hadn't jumped in a kind of a historical manner, like most of these issues wouldn't be a problem. We wouldn't have overwhelmed ports and extreme pricing to move goods and all these delays. But when you have a demand spike of 10%, whenever like you're kind of geared to deal with maybe 2%, that changes everything from a logistics standpoint. And especially obviously with kind of a just-in-time, super efficient system, if you have that big of a statistical jump, we can't handle it, and obviously we can't. So, and that's about to get a lot worse, because the production of some key items is either slowing, getting cut down, or prices are exploding for certain things tied to the energy crisis, where you look at recently with zinc or magnesium, fertilizer prices, a lot of these things where because of their input costs, or because they had to like literally stop producing or dramatically slow down producing, the cost is flying higher. So you're going to have supply shortages of a lot of goods. And again, it's not all just because supply side. So yes, like obviously China doesn't have enough coal, and Europe doesn't have enough natural gas right now. But if you kind of take a closer look, the demand for those things is sky high. Part of it's because of weather, but part of it's, like in China, like manufacturing has been through the roof. So, and industrial takes a lot of electricity. So again, the demand side is kind of creating its own, supply problems, as, you would expect.
Mm-hmm. So from this perspective, Chase, how do you look at the inflation year over year numbers?
So really, you just have to kind of take that and look at where it came from. So the year over year, like where it was last year, base effects. And what's interesting is about that is we kind of went through this period where everyone was like, oh, well, inflation's going to go away. It's just base effects. But that's long gone. That's like 3-4 months ago, where that all kind of rolled off, and you're comping against positive numbers, and you can't really blame that. And since those big forces dropped off, not only is inflation not going down, but it's kind of accelerating. And importantly, not just headline numbers are accelerating, but some other important metrics I try to keep an eye on. In my last weekly letter, I talked about this, where the middle of inflation, sort of that median inflation, the Cleveland Fed has a trimmed inflation where they cut off the top 8th percentile and the bottom 8th percentile. So you kind of just get rid of the crazy like inflation deflation numbers, and you just kind of look at the middle, and that just has exploded higher recently. Same with median inflation. So you're starting to see the middle inflation start to like really move, and that's all this stuff we were told that wasn't going to happen. You're just going to get some base effects, and oh sure, like used cars are expensive and lumber's crazy, and now lumber's bad. all that stuff's kind of washed away, and that middle inflation is starting to move on its own, and that's significant. That's why I think markets are starting to pay attention to that, really in the last 2-3 weeks.
So that kind of destroys the transitory narrative. And do you expect that to continue as we see, the fact that we can't rectify these supply shortages?
Yeah, I absolutely do expect it to continue. And the longer it goes, the more entrenched it becomes and the more dangerous it becomes. But at the end of the day, you either get rate hikes to like slow demand down, mm-hmm. or you get significant investment and production capacity to increase, which will be tough because labor is already really tight. So you'd have to have significant productivity gains, and you'd have to make wages that much higher, you'd have labor just be that much more tight. But I think that's kind of the argument against panic raising rates of a lot is you'll kill demand, but you also won't have that opportunity for businesses to expand capacity and spend a lot and help really grow the economy and get wages on even a real level moving higher. Because if you all of a sudden have a renaissance in investment, and that brings on the new supply, you can actually get inflation moving back down while at the same time you have strong wages because you have to meet all that demand. So that's kind of the two choices, and we're so used to using monetary policy as sort of the tool for everything that I think everyone just assumes like, oh, well, they'll just raise rates and they have to get rid of inflation. But that's not the only way to get rid of inflation. Monetary policy really isn't even that great of a tool to create or destroy inflation a lot of the times. But it's going to be interesting to see what happens, especially next year with monetary policy along those lines, and to see if businesses will get out and really expand capital expenditures and really invest to increase their ability to provide that supply.
So if we think about the Fed raising rates, as you mentioned here, what do you think is the actual appetite for that, considering that we have so many obligations on the federal debt that if we raise rates, that really puts a real constraint on being able to meet those obligations?
Sure. So personally, I think a lot of that thinking is overblown. So what's important to me though is real rates, not nominal. So you can have all the rate hikes you want as long as you're keeping real rates low, or in this case pretty negative. It's that where you start getting real yields moving higher. That's where you kind of start breaking things, and that's where issues happen. But even when I look at the federal debt, a lot of people. I think private balance sheets, it's important to take a look at that. But when it comes to the government's balance sheet, the Fed can just buy all they want. And whenever I see the Fed buy something, I just consider that money just dead. Like, it's just gone to money heaven. It doesn't matter anymore. It's not even debt. I don't consider it debt. Mm-hmm. I know a lot of viewers, listeners are going to find that to be really problematic. That's going to bother people, but that's just how I view it. I think if Japan just formally canceled all the debt on the BOJ's balance sheet tomorrow, no one would really care, and not that much would actually happen. I think when you look at it that way, the debt load from the government perspective isn't as bad as it looks. It doesn't mean it's not bad. It doesn't mean it's not forcing the end of this business cycle or this long-term debt cycle, because it is. And that's not to say there's not significant pain to happen because of that. Like, we have to pay for that. It's just going to be paid for through an inflation tax, not raising taxes or cutting benefits or anything like that.
So longer term, what does that environment mean for the dollar? So
it's really difficult because that at the end of the day depends on what is everyone else doing. Mm-hmm. It's easy to think like, oh, we're going to print a bunch of money. We're going to keep real rates really suppressed. So that means the dollar has to go down, but it doesn't mean that. I think the dollar probably will go down, kind of medium term, just because, again, cycles, the dollar tends to move in reasonable cycles, and it should be entering one of those weak areas. But there's some other really important drivers where the ECB like obviously wants to stay more loose than the Fed with monetary policy. It doesn't mean they'll be able to, but you also look at the energy crisis. I think the energy crisis will come to the United States as well, but it will come to the United States probably last and probably less than it will hit Asia and Europe. And if you have an energy crisis in Asia and Europe, then you have, industry shutting down in a major way, which means growth collapses, and that probably craters everything but, the yen and the dollar, the ones that are able to withstand the energy crisis, in a better way. So I have a very careful approach for FX over the next year, especially. I usually have a strong take, on kind of that short-term view for the dollar. But right now, like I could see it going either way in a big way, and for important reasons on both sides. So I'm super long, commodities, and so for that reason, I have to buy dollars kind of as a hedge to make sure I don't, get blown up if there's an event that hurts commodities. But yeah, I don't have a super strong take though.
Yeah, it's kind of interesting, as you said, that really everything comes tied back to energy. And this is a really important theme that you talk about. And in one of your recent letters, you wrote that greening the world's energy needs and punishing fossil fuel supply before or faster than we're able to meet demand for energy without fossil fuels is a recipe for a disaster. So how do you think about this trend going forward, Chase?
Yeah, it's an amazing thing is we're already in the midst of an energy crisis, and people still, it seems like at least, can't see that. So you look at, policymakers in Europe, and they're just kind of, closing their eyes and ears to this energy crisis and pretending like, the decisions they've made in the last 5-10 years, they're not impacting this. They're saying like, oh, all our climate stuff is completely separate from this energy stuff. Well, it's not. If you starve capital from extremely capital intensive businesses and industries like energy is, then you're going to have issues. If you overregulate them, if you essentially put them on notice that they're going to go away and that you're going to subsidize their competition, you're just not going to get enough investment. And when you don't get enough investment, you're not going to get enough product. And when it comes to energy, it's in everything. And I think you're starting to see the ripple effects that are going to wake a lot of people up, but it's going to take some time. So like I was talking about, zinc and aluminum, the prices of these things are kind of going parabolic because energy is such an important input into making these things. And it's easy to lose sight of whenever energy is cheap and abundant, and you don't have to worry about it for most of your life. You don't really dig in and say, like, I wonder what all energy prices impact. We just all take that for granted. But you look at something like fertilizer costs. Fertilizer essentially nitrogen comes straight from natural gas. So if you have a really bad natural gas problem, you're going to have a really bad fertilizer problem. And I don't think, the average investor or the average citizen realizes how significant the price of fertilizer is for the price of food and for a farmer's profitability. Like, they may decide, well, we're not going to plant much this year because we can't afford to. And what that does to, global inflation and food inflation is just really significant. And that creates political crisis, the kind of political crisis that, some of the decision makers that kind of helped us get here because of their energy ignorance, to be frank, it's the kind of instability that they do not want to see. It. They don't, they think about Europe. They've kind of gotten away from populism a little bit in the last, 3 or 4 years. That's kind of gotten more stable. Well, if food and energy prices are through the roof, if there's blackouts in the winter, populists, their message, they'll be happy to tell everyone like what went wrong and why and how to fix it. It probably won't be fun, pretty solutions, but that's the kind of stuff that happens. I think everyone knows by now that food inflation is what leads to significant political issues. You look back at like Arab Spring, things like that. Food inflation was, an important driver. It wasn't all of it, but it was an important driver. You think about what, food inflation is going to be like in a place like Turkey come 6 months from now, like what that will do to their society, what that will do to their government, their policy making. It could be, it's very significant. That's a very strategically important place. And Turkey's not the only place that will have political problems from food inflation, but it's one I think about a lot.
Yeah, it's so interesting to think about how all of these things are really so interconnected, and they will really have longer term ramifications that, like you say, most citizens don't necessarily think about. But you're a student of weather cycles as well, and you're looking at investing based on this view. And you wrote that, I think that this is priced incorrectly and that this means the opportunity is substantial. So how do you go about investing based on this thinking?
Yeah, so the weather, as I have a weather thesis that we're gonna have a really cold winter at the end of the day, and it's due to a lot of overlapping longer term weather cycles that impact our climate. And obviously, like, weather experts aren't going to agree with that because they don't really take things like space weather into account very much, whenever they're making climate models. There's a lot of just interesting, things in this weather cycle stuff. Even the fact that heating kind of leads to cooling because of the way the oceans work. There's just a lot. There's a lot to unpack there. It's a very difficult subject. But what's important to me, and I tried really hard to highlight when I wrote that piece, because it was by no means a dissertation on weather, because I'm not an expert. But what was important to me was none of that was priced in. So if we have a really cold winter, that was not priced. And I wrote that in July, ran it in August. Obviously, the price of natural gas and coal, even like propane, a lot of winter specific assets has like really moved a long ways. We've had big spikes. So I've already gotten a lot of what I was looking for in some prices, but I still just don't think a really bad winter is anywhere close to being priced in. And you can see that, if you look at the natural gas futures curve, if you look at heating oil prices, the spread of heating oil to just regular crude oil, almost any of those trades, you just can't really see any like really bad winter priced in. And so from my standpoint, it was like, all right, well, if I'm right about this winter thing, I'm going to make a ton of money because it's not priced at all. And if I'm wrong, which, hey, I might be, like, I'm not a weather expert. If I'm wrong, it's really nothing happens. Like, you look at something like heating oil, it does whatever oil does most of the time. So if I'm long heating oil, I'm long crude oil with a free call option on a bad winter. And that I want to be long crude oil anyway. So that seems like a good place to park some money. And, obviously there's a lot of other trades that I put on for this kind of winter thesis, but that's how I was thinking about it, is just a pure risk reward standpoint. My risk isn't that high. My reward's huge because no one else is thinking about this, disastrous, cold winter.
And as you say, you had to learn about the heating oil market from scratch.
Yeah.
So explain to us a little bit about this market and how much of the country's households it actually heats.
Yeah, so it used to be a significant portion, and now it's not. It's mostly just folks in the Northeast use heating oil to heat their homes in the winter. But it's still a liquid futures market, so it's very tradable. But yeah, like, it's a small percentage that use heating oil. It is something that's kind of just steadily lost market share. But I went and looked at inventory data, and the inventories were at their at the lows for where they are at this time of year for a 5-year history, a 10-year history. So again, that shows me, like, not too many people are taking the winter thing seriously, because people would be already kind of storing up on heating oil. And if you go to the Northeast, obviously people will have some other means to heat their homes, but most homes, like a lot of them, the primary way to heat it is to get heating oil, and that's just like a local retailer that will bring it to your house or you go get it. But I could just easily see that breaking down and having a kind of a nasty spike in the spread between heating oil and crude oil this winter, especially if the winter is bad in the Northeast, which a lot of people don't think it will be, but I think it can at least be worse than normal.
And as we think about inventories for fuels that are used for heat, propane and natural gas are also at lows, are they not?
Yes. So in the U.S., the natural gas inventories they're below like 5-10-year average. Not like crazy the way it is in Europe or Asia. Like Europe especially, there, if you look at theirs versus like their 10-year average, it's just off the map. Is bad when it comes to how much they have going into the winter, especially because they don't store a lot themselves. They get it all via pipeline and LNG. So not only do you not have enough stored up, but you are depending on others to get that supply as you go throughout the winter. And if other people are running low, they're probably not going to give you any. So I think that can get really messy for Europe. In the U.S., we will probably enter winter with less than we normally have, but not like extremely. A lot of that too, because we've had a pretty mild October. That's very helpful to get that last push into storage. But again, if we have a couple of just like really bad polar vortex moments like Texas had last year, what that does to supply, it just evaporates very quickly. So it's still easy for me to see significant energy problems in the U.S. I just think, like I said, before, I think it'll happen after Europe Asia, and it'll happen less than Europe Asia. But I do still think we could have a natural gas shortage to the point where we like kind of at least slow down, if not like halt exports. And if you think about, if Asia and Europe are worse than us, and we have to halt LNG exports, what that would do to them, it's extreme. It's not a very pretty picture, but I really think that could be the case. I think, and there are some very uniquely situated places like the UK where they keep such a tiny amount in storage that it's made them very fragile going into the winter when it comes to things like natural gas.
Yeah, I think that's a really important point worth reinforcing, is how low some of those inventories are, and how those heavy importers of energy like that, how negatively they could be affected. I was reading an article, I think last week, about how Taiwan is a massive importer of natural gas, and how many of their industries that are important for the world could be affected by the lack of natural gas, right?
Yeah, absolutely. And we're kind of feeling that squeeze out of Europe and Asia both so far. But yeah, to your point, I mean, I'm mostly talking about like commodity things, but that ends up feeding through into even things like electronics that are incredibly important. So you end up in a situation where you're faced with break the economy and break significant supply of strategic assets, or turning off the heat and the lights for regular people. And that is an incredibly difficult decision to make if you're a policymaker, and it's not one you ever want to have to make. But it honestly could be one that some governments around the world have to make this winter. And again, frankly, it's because of energy ignorance that has led us to this point, because people just, I don't think, have a real appreciation for the role that fossil fuels still have to play.
I think that's a great way to phrase it. Energy ignorance. I like that. So we recently saw that China will be intervening in coal prices, and you wrote that this threat will bring an equal and opposite supply reaction. So how do you see that action playing out for them?
Yeah, so I think this could be slow moving, but so they only import 10%, which means they control a lot of their own production, which means they do have significant leeway over the way that's run. And that isn't all state-owned enterprises, but some of it is, and they can definitely put their thumb on those businesses. But the point I was trying to make is, if you hold the price of anything well below the market price, people will find a way to create less of it, and no matter what. So we actually saw this with coal plants in China, where there was the giant mismatch between how much they paid for coal and how much they could charge for their output, because it was heavily subsidized, and they put caps on the prices of electricity for obvious reasons. So that turned into a thing where the coal plants the power plants looking at it like, well, we're going to lose a ton of money, or we can produce less. And that's obviously, the government can be like, oh no, you can't produce less. But you just say like, ooh, yeah, we have an outage, we have to fix this equipment over here, and it's going to take a week. It's as simple as that. And I think that happens with, coal like mines, because they told all the mines just go full blast. And this is after they told, the mines, a year or two ago to like really scale back. And earlier this year, there was a lot of safety problems in Chinese coal mines, a lot of deaths, and that freaked China out. And they told them like, hey, you guys need to like fix these safety problems and slow down. Part of that was climate stuff. They want to lower the emissions. They want to get away from coal eventually, but at the same time, they were worried about, these safety issues. Well, if you tell them all to go full blast and just turn the volume up to 11 on producing coal, they'll have to take a lot of shortcuts. They'll have to, do a lot of really dangerous stuff. And sure, like everyone knows the government told you to do it, but at the end of the day, there's real people going in there and risking their lives. And there are real people that are their bosses that know they're risking their lives. And I just think you probably get a lot less production response than you think, because people will find a way to try to do less, because of the price, because of the safety, all of it. So, and I think demand is going to stay incredibly strong throughout the winter for electricity and for heat. So I think, yes, will they keep the prices down for the next month or something, maybe 2 months? Sure, that's possible, because they're dropping about 10 tape bombs every day. to keep coal prices down. And it works short term. Everyone just wants, traders want to get out of the way of that and just let the dust settle.
Mm-hmm.
But when the dust settles, like, I think prices go back up. And if you're an importer, like that they have their thumb on the scale. So you're saying like, yeah, that's cool that, your futures price dropped to that level because you made it drop to that level, but that's not the price we're going to get. So you can pay up, or we'll take our coal over to India because they need it just as bad as you guys. So imports prices aren't going to go down much, I wouldn't think. And even domestically, I think they'll struggle to get the production they want. And eventually I think prices go back up even internally.
So taking that, let's say, lack of energy production into account, this dovetails nicely into your thoughts around why China got rid of the crypto miners. I think this is it's a really interesting point to look at. So what was your explanation for why they got rid of the crypto miners?
Yeah, so for me, this was a leading indicator that I was using to kind of gauge where the Chinese energy crisis was at. And this goes back months. Whenever they kind of started to crack down on Bitcoin mining, like, it didn't make sense to me. I was just like, no, like, it's kind of a big asset for them to mine, Bitcoin there. It's a great way for them to get access to dollars that they badly need, is to, mine some bits in the sky and then go sell them for dollars. That's a great business to be in if you're China. So whenever they started really cracking down on it, I was like, no, this doesn't make sense. So I thought about it, and I was like, well, what's unique about Bitcoin mining? It takes a lot of electricity. And so I just kind of went in to look at some of the stats on, where their inventories appeared to be for things like coal and natural gas, where their electricity production numbers were. Like, that was, going straight up. They didn't have enough coal. They didn't have enough natural gas. So at that point, I was like, okay, I think this is because they're freaking out about electricity. And so that kind of started using that as a leading indicator. Like, the harder they crack down on mining, the worse their electricity crisis is probably, getting. I mean, obviously they've never said, yeah, that's what that is. But in my opinion, that's been what it is. And that really helped me kind of see this, over a longer term horizon than I think a lot of people were able to. They kind of waited until China said, hey, we have a giant energy crisis. And then everyone started writing about it, Bloomberg and everything. But if you were watching things like Bitcoin mining, even 4, 5, 6 months ago, you could see like there might be an electricity problem here.
Mm-hmm. Yeah, it's a really interesting parallel you were able to draw there. So when we think about, let's say, baseload energy and electricity production, how does nuclear energy fit into your thesis here, and how are you investing in it?
Yeah, so that winter monthly piece I wrote back in August, that the part that got the least fanfare that I thought was kind of most important was nuclear, because I said, nuclear has always been just a truly fantastic technology. It's like a miracle. As Josh Wolf recently said, if we just discovered this today, we would all be freaking out about how we just solved the climate crisis. Like, this is going to change the world. At the end of the day, you just dig some stuff out of the ground, and you can basically turn that into very, affordable, very clean, very safe, zero emission electricity, and it stays on 24/7. It's like a miracle that was, just handed to us by nature. And in the last, 20, 30 years, we chose to just kind of think, nah, like, let's not use that. And let's build, enormous steel windmills and use a bunch of coal to make, electricity or to make it, solar panels. Like, we were handed such an energy dense thing, and we chose to go out to do much less energy dense, where you have to invest tons of energy to get energy out. And that's dumb to me. So the way I saw this is it's like the perfect technology that has a PR problem, it has a sentiment problem, and it has, kind of a pricing capital problem, because it's extremely expensive to build nuclear plants, and that people associate that with just, it's expensive to do nuclear. But whenever you have natural gas, at $200, $300 a barrel oil equivalent, now all of a sudden nuclear looks really cheap. And the fact that its price doesn't spike, up and down with the supply and demand of natural gas and change with the weather, the way renewables and fossil fuels do, frankly, then, obviously it starts to look a lot better. So you're already seeing it. In that letter, I said, hey, like, this is going to change everything for nuclear, because it's going to change the PR. A lot of people that hate nuclear are going to have to embrace it. If they want to keep emissions low, to me, your two options are, okay, forget it. Let's just go crazy go back to fossil fuels, like full blown, who cares? Or your other options to do nuclear. Anything in between that is just fake. Like you're not gonna solar panel your way out of this problem. You're not gonna windmill your way out of this problem. Now, if you could get, grid scale battery technology to really take off, then yeah, you can use renewables in a much more meaningful way. But that hasn't been commercialized in any way that's meaningful yet. And I have no idea when that will happen. And frankly, most people that talk about it don't know either. So with all that as a background, to me, is like, okay, nuclear has this enormous catalyst coming, and it'll probably come this winter. But we're already seeing it, where multiple countries are kind of changing their stance. Multiple organizations that are, anti-nuclear, whether it be, green parties in parts of Europe, kind of changing their stance. The UK has gotten a little more aggressive. France is like, the best place in the world for nuclear. They were backing away, and they were going to retire plants and stop building new ones. Well, now all of a sudden there's like, well, yeah, we're not going to do that anymore. In fact, we're going to invest a bunch of money and build some new ones. So you're starting to see that shift. And in my letter with my clients, it didn't get a ton of fanfare because everyone's focused on, the Sprott, physical uranium trust, and rightfully so. That's a huge driver short term. But what's to me much more important is the long term driver of the world kind of turning back to nuclear as a significant source of baseload power, which I think we're in, the early innings of the world realizing that that's exactly what we have to do.
Mm-hmm. Yeah, again, it just kind of comes back to this thing of the idea that we're not ready to turn on these renewable sources of energy to be able to rely on them like that, right?
Yeah, exactly. And not only that, but you can't rely on them because they depend on things you can't control. So we've seen it a lot this year with droughts taking out hydro in places like the American West or in Brazil. The wind stopped blowing in the UK. That was a major problem. We see some issues with solar where they're not lasting as long as we thought they would. So the cost profile is different than all the estimates were suggesting. So and obviously if it's cloudy, you don't get solar power. Which, speaking of part of part of my weather cycle is to look at this is you get more clouds during a solar minimum. So because of that will kind of hurt, on the margin at least, solar. And when that happens, if you have unreliable energy, you have to have reliable energy to back it up if you want to keep the lights on. So that's where you get all these like peaking plants where you have natural gas plants just kind of sitting there, coal plants just on standby. They turn them off, but if you need them, you got to fire them up. So if you really want to have enough backup for all this renewable, you still basically have to have about the same capacity of fossil fuel electricity production that you had going into it. So there's just a lot of misnomers about the way renewable energy works and the way it will work, and that has led to a lot of the mistakes we've made, with energy, and that's unfortunately starting to kind of rear its ugly head right now.
So Chase, from your real macro view, macro lens here, considering all of the energy input costs and stuff like that, how does this affect the metals to you?
So obviously it's going to make, just inflation go up. And interesting to me when it comes to metals is there's kind of always the argument over how much of an inflation hedge, especially gold is. And to me, personally, the way I see it is gold is a really good deflation hedge and a really good inflation hedge. It's not a very good kind of in the middle hedge. So if inflation's just kind of chugging along at 2 or 3%, this is not that effective. Like no one's worried about it. But whenever you start getting this 4 or 5% inflation and it starts sustaining itself, that's when it becomes a much more important place to store some wealth in my view. That and in significantly deflationary scenarios, because you're going to get an immense amount of money printing in those cases. So because I see all this energy inflation coming, that feeds through into everything. That feeds through into all inflation. So I think this current 5% inflation environment. Will inflation go down here in a couple of years? Because of a lot of these supply problems taking care of themselves? Yeah, of course. And I don't think we're in this MMT moment where we just get tons of fiscal all the time, every time. Anymore. We have never done that outside of emergencies. So until we do it outside of emergencies, MMT is not an important framework, to invest by. So yeah, because I see us in that kind of higher inflation regime in the coming weeks, months, whatever you want to, however you want to look at it, as long as the dollar doesn't go too crazy on some of these energy mismatches, then I think metals can do really well. They can have a nice run. It's going to cost a lot more money to get them out of the ground, and that's going to make them, they're going to have to cost more money. So I think they have a bright future. And if you look at the thing I track most when it comes to metals, and I think a lot of people do, is real yields. You kind of need real yields to be muted and stay low, stay negative for gold to do well. And that's kind of the question. So that really comes down to Fed policy. If they start panicking and tightening because they're worried about inflation, that could be a problem. That could be a big problem for metals. So you need the Fed to stay behind the curve on their inflation fight, which I, as of now, at least expect them to not, panic. I don't expect a 50 basis point, rate rise in the first half of next year or anything like that. But if they get to that point where they start getting scared by looking at median inflation, things like that, and they kind of panic raise, then gold's gonna have a bad time. But my base case, they don't do that. They take it slow, and that lets gold, silver, kind of run. And if you look at things like platinum, palladium that have a lot of industrial inputs, I mean, so does silver, but you have a shortage of a lot of things that they feed into. So whenever auto production gets ramped really back up, I think you can see platinum, palladium start to catch up. So weirdly, they're kind of tied to semiconductors at the moment. You need semiconductor supply to come back so that auto supply can come back, so that the demand for those metals can go back to where kind of normally is.
Mm-hmm. So considering that you're not necessarily like a gold bug, how do you think about, let's say, the role of gold as an insurance policy in your portfolio?
Sure. So funnily enough, I think anyone that follows my work wouldn't think me of anything close to being a gold bug. I honestly consider myself a gold bug. My economic roots were very Austrian, and just as an Austrians, we all just have a lot of love for gold. I don't really consider myself an Austrian anymore. I don't consider myself in anything when it comes to kind of having an ideology. But I do still consider myself a gold bug. I just find it to be a very important asset. It's a cornerstone in my long-term portfolio, because I just want it for those times when other things aren't doing well. There are regimes where gold does well and a lot of other stuff doesn't. And even something that has a negative expected value at times can be a super important part of your portfolio. That sounds weird that you could outperform by having something will actually lose money over time. But that's true. That's how kind of that drawdown math works. And because of that, I think everyone should have a good bit of gold in their portfolio. I have more than most people, I would say. I like physical. I actively trade futures often, and sometimes I like miners and sometimes I don't. Right now, I think miners are in really good shape. They've really done a lot with their balance sheets. They've done a lot with their expenses over the last few years. There's some really good assets out there when it comes to miners that to me look really attractive. They got cut in half because of this kind of big flag that gold's put in. And yeah, I think there's a lot of ways to make money in gold, and it's a significant hedge to have in your portfolio. And it doesn't have to just be just a hedge for inflation. I think that's not really the right way to look at it. I think it is a hedge against inflation, and I don't think it's losing out fully on that status to Bitcoin the way a lot of people do. But it's a hedge against, it's just not correlated to other things the way a lot of assets are. So just an important piece to have in your portfolio.
Yeah, it's really interesting to think about it from that perspective. So Chase, when you're taking this wider lens view, how do you determine trading timeframes, considering this large macro lens?
Yeah, so I actually run two kind of portfolios in tandem to kind of facilitate this. I have what I consider a tactical portfolio and a strategic portfolio. The way I think of those is that tactical bucket is going to be under 6 months, and the strategic bucket is something I plan to hold for more than 6 months. Obviously, plans often don't work out, and a tactical trade may last for 10 minutes. I get stopped out, and it may end up lasting over 6 months every once in a while. Same with strategic. I may change my mind after a month of buying something, but usually those things kind of sit tight for long periods. And I do that because it's just gonna be conviction levels will be different at different times. Sometimes something's obviously just a good trade. So Chinese tech, I bought a lot of Chinese tech a couple of months ago just because the chart looked really good and everyone hated it, and that's good enough reason for me to put on a tactical trade sometimes. And there's other things like, whenever oil went negative, I wasn't just a little bit bullish on oil. And everyone hated it. I mean, everyone hated oil. That's the time where I want to like load up and put just a big chunk into my strategic, longer term portfolio. And just looking at the fundamentals of that, I knew like there's significant runway here. It's going to take a long time to get these prices down. And you could track that because you can see how much people are investing into production. It's sort of like someone showing you the future with those kinds of metrics, and why not use that? So if I can see the future in that way, then I can have more confidence in holding something long term. Whereas sometimes in these tactics, so gold for me right now, I mean, I own it in my long term portfolio. I always will. It's like I said, it's a cornerstone. But I'm probably about to get long in the tactical portfolio as well, and those do overlap at times where or I might be tactically short something that I'm strategically long. Like those are very independent from each other. But I can see myself getting tactically long metals because A, the charts look good, they're about to break out, and B, like I can see the macro reasons for this to work in the next few weeks. But then I have that that dollar worry of an energy crisis helping the dollar kind of out there as well. So like for that reason, I'm not willing to go out and add a bunch in my long-term portfolio because I see a big risk. So it's all about calibrating, the fundamentals, the technicals, and, the way those work together. And then just, my level of conviction, and in the timeframes, my level of conviction.
Mm-hmm. I'd like to go back to how you analyze miners real quick. Are you looking at, let's say, the valuations, considering how less owned they are and attractive the valuations of these companies are compared to something like, Netflix or Uber, something like that? Or is it just based on, the macro lens of the miners and let's say the quality of the project itself?
Yeah, it tends to be more the latter. So I always tell my clients, like, I'm just an awful single stock analyst. Like it's just not what I was built to do. If I find tearing through balance sheets to be A, boring, and B, just not useful, because macro moves everything more than the independent factors about a company, and minus outside of like big shocks, good or bad. But obviously someone finds a bunch of gold, like things are going to change or whatever. But I take that macro approach. I take that strategist approach, even when I am using individual stocks to express trades. It's usually because I just see significant value in one company over the rest. But I also I try to spread that stuff out as well, because I know I'm not good at a single stock analysis. So for me, if I'm looking at something like gold, the quality of the project matters to me. The quality of the management team and their reputation, what they've done in the past, matters to me. So I don't mind riding blue chips, but I also don't mind taking a speculative bet if someone in my network that knows way more than I do, about a project tells me like, this, hey, this may be a zero, but if it's not, like, this thing could go really high. So I lean on other people that are better at, the fundamental side of individual companies than I am, because I'm not good at it. And because of that, I try to take that like good management team kind of approach, because good people tend to do good work over and over. And in my opinion, you really see that in the resource sector.
Excellent, Chase. As we wrap up here, is there anything else you'd like to add?
No, it was a great interview, and I appreciate it. Well, the one thing I will add is I tease it a little bit, but I keep an eye on corn, especially next year. I think fertilizer prices can significantly impact what happens with corn going into next year, and some other agriculture products too. But I think corn could get really interesting next year.
Excellent, Chase. I really appreciate you sharing all your interesting perspective with us here today. Of course, you're available at pineconemacro.com and on Twitter at Pinecone Macro. Anywhere else you'd like to point our listeners to?
No, that's good. And on the website, we're about to roll out a new website here in a week or two. So that's going to go from being really bad to really good here soon. So looking forward to that.
Excellent, Chase. Thanks so much for your time today.
Yeah, thank you. Appreciate it.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.